I'm in the camp that we have not really seen the peak associated with a 4-year cycle. In fact, in some ways, because of muted monetary liquidity and all the suppressed animal spirits, the market's been super concentrated this year. I think that the best prices are going to be seen next year for both Bitcoin and Ethereum.
When you hear people talk about BRICS and creating their own currency, they're not going to be able to create their own currency. But what they're going to do is get away from the US dollar and US Treasury. Who wants to own US Treasuries when the government, in a monumentally stupid mistake, like this is categorically catastrophic for the US Treasury for them to do this, because they just signaled to the world that, hey, if we don't like what you do, we're gonna seize the treasuries that you have and we're gonna kick you off SWIFT.
The crypto market isn't dead, it's brewing. Underneath the noise, the volatility, and the premature eulogies, a deeper narrative is forming. One shaped by broken trust, fading monetary illusions, and the slow, quiet rebellion against fiat. Investors aren't just reacting to charts anymore. They're responding to a global shift in how we measure value, protect wealth, and challenge the old guard. As 2026 approaches, it's becoming clear that the real story isn't about meme coins or hype cycles. It's about what happens when legacy finance starts to eat itself, and Bitcoin, like gravity, is just waiting. Tom Lee, ever the data-driven optimist, thinks we haven't even touched the top of this cycle. According to him, the market's been strangled by weak liquidity and suppressed investor enthusiasm. In that kind of environment, Bitcoin and Ethereum haven't had their full run yet. He's looking at next year not as a cooldown, but as the moment animal spirits come roaring back and crypto finally gets its tailwind. While Tom is watching for liftoff, James Lavish is sounding alarms. For him, the real risk is geopolitical. When the US government weaponizes its own debt, threatening to freeze treasuries and cut nations off, it's not just a policy blunder. It's a neon sign flashing. Find an exit. Let's watch clips from Tom Lee's explosive interview to gain more insight.
When I look ahead at 2026, I think it's a really attractive setup. Monetary policy's been tight for 3 years now, and we're just beginning to get some easing, but we also have a new Fed chair, and I think that the idea is to unleash and improve monetary liquidity. That's a big tailwind. The business cycle has been muted for the last 4 years. You know, the ISM manufacturing, which is a measure of business activity, has been below 50 for 36 months. It's the longest stretch below 50 in the history of the ISM survey. It shows you business confidence has been muted because of inflation and then Fed tightness and then policy uncertainty and tariffs, but that all clears next year. And we know that investors are very skeptical because sentiment remains negative and people talk about an AI bubble, but measurable surveys like AAII show people are negative. And that's a contrarian tailwind because when everyone's bearish and they're sitting on a lot of cash, then if the market moves away from them, they're going to chase that. So I think that that's a formula that's very supportive of stocks next year. However, the timing is a little uncertain because we're coming off 3 years of really good gains. So I think that the first part of next year, maybe the market has to digest that a bit, but it should play out really strongly for the full year. Well, crypto's been disappointing the last few months because prices are down a lot. And when prices are down, first of all, we know the mood turns really dark. People get second guess, especially because price is so important as a signal in crypto. And now people are really worried that this is the start of the 4-year cycle of the downturn, which might last a year. So that's at the back of people's minds. But I would say people should be wary that price isn't always signal, because there's times when there's fundamental developments that are really building. And I see this in equity markets all the time, while price remains skeptical. I think we're in one of those moments because Bitcoin has become an institutional asset. So that's very different than the last 10 years. Well, really 15 years for Bitcoin. It's for the first time has a different buyer. And the US government just about to finalize the Clarity Act and some action regarding the Bitcoin Strategic Reserve. That's a brand new buyer. And on Ethereum specifically, there is a huge runway coming because of stablecoins, which is a tokenization of a dollar, but it's just the start because we know that BlackRock and Robinhood and everyone else wants to tokenize everything on the blockchain. That's a big unlock of activity, which is going to happen regardless of whether prices of Ethereum and Bitcoin aren't going straight up, because these are innovations in financial products. So I'm in the camp that we have not really seen the peak associated with the 4-year cycle. In fact, in some ways, because of muted monetary liquidity and all the suppressed animal spirits, the market's been super concentrated this year. I think that the best prices are going to be seen next year for both Bitcoin and Ethereum.
Have we waved goodbye to the typical cyclical movements that we have no crypto to be standing for?
It's a good question, and the way this is ultimately proven is if Bitcoin makes a new high before end of January, which I believe will happen. But we did talk about that in the most recent BitMine chairman's message from November, that we looked at things that could explain the 4-year cycle of Bitcoin. In the past, what peaked that explained why Bitcoin was following that cycle. The two things that really explain Bitcoin's price peaks that were not time related, like not just saying the clock, was the copper versus gold price ratio. That makes sense because it's industrial activity versus monetary base. That has always peaked in coincidence with the past peaks of Bitcoin price. But copper to gold has actually been at a low right now, meaning we actually haven't seen copper gold peak. Why is that? I think part of it has to do with stablecoins buying so much gold this year. They are the single biggest buyer of gold. They've driven gold to an all-time high. And that means there's a huge move coming in copper. The second is, then that will mark the Bitcoin peak. The second is the ISM. ISM has always peaked in coincidence with the Bitcoin price peaks in the past. But as I mentioned earlier, ISM has now been below 50 for almost 40 months, the longest stretch in history. Until the business cycle and industrial cycle peak, I don't think Bitcoin's going to peak in price. I'm really looking forward to being at Binance Blockchain Week. It's happening in exactly the place you'd want it to, which is Dubai, where there's so much crypto innovation taking place. But also Dubai is where a lot of AI hyperscaling is going to take place, and even a lot of compute. And we know that crypto and AI are going to start to intersect in the agentic world. So I think it's an ideal place. I think what people are going to hear from us is really this vision of why crypto is entering a much different phase where it's becoming central to the economy. Up until now, Bitcoin and Ethereum and altcoins have all been a story of price, and it's created a lot of wealth, and it's really drawn in a community of dedicated people, but it hasn't created products that have actually worked in the real world. I think that's finally changing, and that's what makes the next 5-10 years so exciting. The first is, of course, we know we're in the midst of a downturn for crypto prices. Bitcoin and Ethereum are the ones everyone is watching because they're the two largest, and Bitcoin, of course, is the flagship. I think we are so close to the bottom here, especially for Ethereum. I mean, the bottom could be happening this week or within the next 4 days. And from there, we are going to have, I think, a V-shaped recovery because of the liquidity that's coming as the shutdown has ended, the US government shutdown. And also because the central bank, I think, is tilting dovish, especially with a potentially new Fed chair. That, I think, should propel prices very strongly into the end of January. And that's where I think Ethereum, could be 7,000 to 9,000. And I believe Bitcoin is going to recover to past its all-time high by that time. Gold has become not only a story that has shown it maintains itself as a store of value, but it's very likely going to be tokenized on the blockchain. So gold is, joining the blockchain revolution as well.
2026 might be the year everyone wishes they had paid closer attention. After a long stretch of tight monetary policy and historically low business confidence, the gears are finally starting to turn. A new Fed chair could signal a major shift in liquidity, and that is not just a win for equities, it is fuel for risk assets across the board. While most are still licking their wounds from recent downturns, the smart money is watching sentiment, not just charts. And when pessimism is this widespread, it usually does not end with a whimper. It ends with a sprint. Crypto's recent price action has been frustrating, but price is only part of the story. While everyone panics about another 4-year downturn, the real transformation is happening under the hood. Bitcoin is no longer just a trader's asset. It is being treated like a sovereign reserve. Ethereum is building the pipes for a tokenized economy, from stablecoins to real-world assets. This is not hopium, it is infrastructure. The next wave will not look like the last one. Tokenization is going mainstream. AI and crypto are starting to overlap, and the biggest players in finance are quietly getting into position. Forget the noise. The opportunity is not gone. It is just hiding in plain sight. While Tom Lee focuses on market recovery and sees 2026 as a breakout year driven by renewed liquidity, James Lavish isn't buying the optimism. He shifts the lens to global distrust, warning that U.S. financial policies may be backfiring. From tailwinds to red flags, the tone changes fast. Let's watch clips from his interview.
Look, I was in Washington a little over a year and a half ago, and we were talking to congressional aides and congressmen, senators, Senate aides about Bitcoin and cryptocurrencies, and just trying to educate them a little bit about, what they are and why they're so important. And we got into one of my local senators' offices, and the aide was like, "Oh yeah, we met with Tether. We know how important this is. We understand how critical it is for us to embrace stablecoins because of the U.S. Treasury." So they got it. This is a long time ago, and they already get it. So what does a Genius Bill do? Well, it allows for stablecoins to be issued by these major banks under strict rules and regulations of the government, with very strict audit capability and all that. So no longer do you have Tethers just saying, "Well, we buy what we buy, just trust us." It's going to be like Circle, with Circle's like the gold standard for the audit of the underlying holdings of these stable coins. But what are they? For the listeners who don't know, a stable coin it's a cryptocurrency that is pegged to something, anything. It could be pegged to gold, it could be pegged to copper, it could be pegged to rupee, whatever you want. But by and large, the vast majority of them are pegged to dollars, US dollars. And so why is this important? Well, it's important because exactly what you said, Ben, is that you can have access to an exchange that offers stable coins, Tether or Circle or something else, a USDC or something else, but if it's pegged to the US dollar, then you can effectively get dollars without actually having dollars, because it's pegged to it. It's pegged to the US dollar. So now if you want to hold your money in dollars rather than your local currency, if you're in Venezuela or Argentina or Egypt or somewhere where you have a very high inflation, then you can hold it there and be pegged to the dollar and kind of protect your hard-earned money, currency, whatever, assets. Now, of course, we know the dollar is debasing, so it's not great, but it's debasing at a lower rate than most everything else. Then what do the stablecoin issuers do? They turn around and take that currency that they've been, that's been subscribed or bought with. They create the stable coin, and they go and buy U.S. dollars and U.S. treasuries. And so what the point of all of it is that it allows the U.S. Treasury to find pockets of liquidity for treasuries, for U.S. Treasury sales that they didn't have before. And there's a billion people across the world who are unbanked. If they're able to go and buy U.S. dollars, then they're effectively pushing them into U.S. Treasuries. It's another avenue to get people to buy treasuries. So was that Russian minister wrong about, the U.S. pushing treasuries into the cloud and just revalue them? Yeah, they're not doing that. But what they are doing is they're finding pockets of liquidity to continue the charade that we've been talking about, which is debasing the U.S. dollar with inflation and finding people who will buy it because it's inflating at a lower rate than other people's currencies. It's effectively sucking the currency from foreign fiat creators, and it's just the playbook that Brent Johnson had laid out years and years ago with the dollar milkshake theory. And they're just using a long straw and sucking currency. They're sucking the money out of other fiats, and it's just going to end up in the dollar and end up in U.S. Treasuries. And that's kind of the playbook. Remember how stupid we were back when Russia invaded Ukraine, and we turned around and we seized their assets. We seized their U.S. Treasuries and we kicked them off SWIFT. What do you think Russia wants to do? And that's when you hear people talk about BRICS and creating their own currency, they're not going to be able to create their own currency. But what they're going to do is get away from the U.S. dollar and U.S. Treasury. Who wants to own U.S. Treasuries when the government, in a monumentally stupid mistake, like this is categorically catastrophic for the U.S. Treasury for them to do this, because they just signaled to the world that, hey, if we don't like what you do, we're gonna seize the treasuries that you have, and we're gonna kick you off SWIFT. And then the Treasury's sitting there going, wait, we need them to buy the treasuries. Like, we need buyers of treasuries, or we can't facilitate this idiocy out of Congress of this endless spending, which is the whole point of the Treasury. They're there to facilitate the idiocy. Congress is there to get reelected, so just spend as much money as they need to. And then you've got Biden that turns around and cuts them off the SWIFT network, takes their treasuries, and everybody around the world who is not a very close ally of the U.S. government is saying, oh, shit, I don't think I want to own these treasuries. So they're looking for pockets of where to, so they're buying gold. It's not the U.S. playing with it. That's exactly what's happened. So we paint ourselves into this corner very, very eloquently. I mean, I couldn't have come up scripted a better way to do it. Like, how stupid was that? So, and here we are. The bill prevents the stablecoin issuers from passing on the interest to the buyers.
Well, not to the buyers, but to the as an entity.
Sure, of course. Yeah, that makes perfect sense for them to do. Then they are doing it. I haven't spoken to Circle Management, but of course they're looking for ways to maximize their own treasury, and that would make sense to me, and I would expect that to happen over time, but it is worth noting that these banks, it's insidious that they backdoored this, regulation into the Genius Act, where they're not allowed to pay out interest on these pegged stable coins. Yeah. Wow. Why? Because they're worried it's going to hurt the deposits and, in their banking system, and that'll hurt their ratios. And so they can't have that. So they don't want to. So now they've got a way to issue stable coins and turn around and reap the profits themselves, instead of passing them on to the consumers that are actually buying and taking the risk of those treasuries by having a stable coin.
Most people still think stablecoins are just crypto sidekicks, pegged tokens floating around in trading pairs. But behind the scenes, they're quietly rewriting the playbook for global finance. With over 1 billion unbanked people worldwide, stablecoins offer something radical: dollar access without a bank account. For someone in Argentina, Nigeria, or Turkey, holding a dollar-backed token isn't just convenient, it's survival. And when regulators finally caught on, they didn't shut it down, they joined in. Banks can now issue their own stablecoins under strict oversight. But here's the twist: they get to keep the yield on the treasuries backing those coins. Users carry the risk, banks keep the profit. It's clever, maybe even insidious. This setup quietly funnels global demand into US treasuries, creating liquidity without needing foreign governments to buy in. That's a useful trick, especially now that trust in treasuries is eroding. After the US froze Russia's reserves, every non-allied nation took note. If dollars can be seized, why hold them? Gold is rising. Alternatives are spreading. The US may have built a dollar distribution machine with stablecoins, but it also handed the world a reason to question the game, and that contradiction is starting to catch up. As we wrap up, are you more aligned with Tom Lee's optimism or James Lavish's caution? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.